Hey everybody, Marty Mazzora. Good morning here, 5th of August 2019. Well, in yesterday's video, I said I'd be back soon and frequently, so here I am once again. Yesterday, again on the video, I pointed to some levels here that could be support as the market meanders its way lower amid heightened trade tensions. But I also said if the news over the weekend was not favorable from China, if we got news that they are going to retaliate against the surprise increase in tariffs last Thursday, that we would see a precipitous drop. What we're seeing this morning. China, as I said in the written blog a little bit ago, has asked, I would say, told their state-owned companies to cease buying all U.S. ag products. That was news yesterday, and I saw an immediate multi-point drop in U.S. equity futures. And this morning, the Chinese yuan has dropped in value, or I could say the US dollar has risen in value to above 7 yuan this morning as the People's Bank of China fixes the exchange rate. Now, the president is out this morning accusing China of currency manipulation. Well, indeed, they have let the peg float a bit more than they have recently. I will say this, if they did not have control, if they weren't in fact propping up the currency, given all the news of late, we'd probably see the yuan tank and we would have a much stronger dollar against the yuan than we do right now. So the manipulation going on at the PBOC is really more akin to trying to support the currency against the threat of huge outflows. So not the correct narrative from the president. And frankly, that probably shouldn't surprise us given other commentary. So China, and we knew it. We knew it from the rhetoric. We knew it from what they've been saying. I've been saying it here and on the blog that this is getting very precarious. And now China has put President Trump in a position where he's going to need to probably escalate those tariffs to 25%. That is if he remains at all consistent with what he's been saying the last week or two, that he can go a lot higher, and he will if he doesn't get what he wants. Well, China just delivered the exact opposite of what he wants. Not only are they not going to buy more ag products, they are ceasing buying ag products, according to the news yesterday. So we'll see how that plays out. But folks, I do like to come to the charts because in the charts we can basically just look at reality. And a couple of things I want to add. In terms of seasonality, August is typically a pretty bad month anyway. We've had this really nice run. We have a bearish wedge pattern. I've been virtually promising for weeks that this was going to break out lower anyway. And I said from day one, as we were making our way up in here, that a test of this low down here was actually the norm. Now we're a long ways from that, and we don't necessarily have to test that. Of course, that would be quite dramatic and very upsetting to people and probably to consumers. And therein lies my concern, in that the consumer is really, as I said a week or two ago, in my view, the only game in town right now economically. You've got companies pretty much freezing expansion because of the trade war and because of the uncertainty. You have huge global supply chain disruptions that just isn't good for markets or outlooks or sentiment. All the while, you have a consumer that is now, spending like crazy and feels really good about his and her lot. You wonder, yeah, how much of that is the result of an increasing stock market and great looking 401k balances. It's been my observation that that is huge for consumer sentiment. If this continues and we don't start making sense soon as it relates to China and trade, we could see the consumer roll over, and this is what I'm concerned about, as you know. Politically speaking, this seems to play well. And also on the other side of the aisle, the president looks at those debates and sees the rhetoric. Everybody is saying, we've got to rein in China. We've got to go at China. I watched a clip of Steve Bannon, who is, in my view, someone who should be nowhere near any policy-making process, who was actually part of the team in Washington at one point, who isn't any longer, but I watched a clip of him in a CNBC interview just lauding the president and the job he's doing, and saying that he's the only one who will give China, what it has coming. That he's the only one that'll go hard at China. He's the one we have to elect to stop the threat from China. And then the president tweeted how much he liked Steve Bannon and missed him and so on. Well, he's getting a lot of, political fuel to continue this fight. Problem is, as I've said from the get-go, the markets and the economy will not hold up against this trade war and the escalation that he is virtually promising with other trading partners. My view has been consistently for months and months now that if the president can abandon his protectionist proclivities, the economy continues to do well, the markets continue to do well, and he has a pretty easy time in November of 2020. If he doesn't, if he continues, and if worse yet, he escalates, which has been the case, the markets are going to suffer, the economy is going to suffer, and he stands virtually zero chance of re-election come the fall of 2020. I really do believe it's going to be the economy and the markets that dictate whether or not he wins. So he needs to do that shift. He needs to realize that politically, for him to succeed, he has to abandon what he believes has been working politically to this point. So again, here we are this morning, breaking through some levels. 2880 is being threatened right here, right now. Below that, there's not much support. Below about, right in here, 2850, a little above 2850. And then we go down and test 2800. That's going to be a key level in there. If we see the president jump in and say, okay, they did it, now we're going to 25%, we're going to get there in a hurry, and I suspect we're going to go even lower until somebody comes to the table with a much more conciliatory attitude. We'll keep our eye on conditions and how they're evolving. They're definitely deteriorating. I did not like the look of our macro index over the weekend. And folks, clients, if you haven't been following the blog lately, we are making a concerted effort to reach out to everybody, and we have a lot of folks, to get them signing options approval for their portfolio so we can apply a hedging tactic that we think is important to use right now. Many of you have not responded. The reason we're having to do it this way is because the process is very idiosyncratic. It takes a great deal of my attention when we do the number of portfolios we're doing. There's Nick on the derivatives end. He is the one who actually applies the collar. He and I work together on each portfolio, getting it tweaked right to where we need it so we can apply the collar. So it's a somewhat of a lengthy process. Rather than make calls and try to explain it to everybody, I produced a video that we sent out a couple of weeks ago, been following up with emails directly. Now we're just sending out bulk emails. Need to hear from you and need you to get that paperwork signed so we can apply the options collar to your portfolio. Watch the video and you'll get what I believe you need to know in terms of how it works and what the ultimate effect is. So anyway, I'll leave that there. Click the link that you've gotten in my previous 2 emails and watch that video, and then reach out to me, ideally via email, and we'll get the paperwork to you. Thank you, folks, as always, for watching and listening. I'll say it again. I'll be back soon, and I'll be back frequently. Take care.